Welcome back to another video. So in this video, we are going to talk about the truth about volume. We are going to dive into volume and understand it on a deeper level, right? Now, a lot of people understand the basics about volume, the basics that we already covered, and the basics are right to a certain extent. Now, what do I mean by that? So the basics we learned is that there's no such thing as more buyers than sellers or more sellers than buyers. Another thing that we learned is for every buyer, there needs to be a seller, and for every seller, there needs to be a buyer. So basically, in volume, what we've covered is that if Mike wants to buy 4 shares, there has to be somebody on the other end who is selling their shares to Mike or selling their shares overall, and that will equate to a volume of 4. So once again, what we've covered until now is if you want to buy 4 shares, there has to be someone out there willing to sell those 4 shares to you or buy those 4 shares from you. Right now, there's certain urban myths about volume that we've covered before, which kind of makes sense, but now we want to dig a little bit deeper and understand this at a higher level. So the urban myths about volume is that for every buyer, there has to be a seller, and for every seller, there has to be a buyer. So this is what we have learned, and we have covered this and we have stated this in the previous lessons because I want you guys to understand the basics and I want you to understand how volume is built up. So for each transaction, if you buy a stock, you're selling it to basically someone, and that equates to 1 volume. So if you buy 1 share and someone sells you 1 share, the volume equates to 1. Now, the misconception everyone has is everyone thinks that there has to be a seller or there has to be a buyer. Now, this is where we are going to dig a little bit deeper. We are going to dig a little bit deeper so we can understand the overall meaning behind volume and understand that not every volume is good, not every volume is bad, and there's a deeper meaning behind it. So what do I mean by there's a deeper meaning behind it? So let's break it down. Now, let's say Mike wants to buy 4 shares. Now, if Mike wants to buy 4 shares, and let's say Mike places a market order. Remember, a market order is saying, hey, I'm willing to pay whatever this stock is going for right now. So if Mike buys 4 shares and places a market order, right, that means he's willing to buy it for whatever the market price is. Now, the misconception is that in order for Mike to sell his 4 shares, in order for Mike to buy the 4 shares, there needs to be someone that is selling it. There has to be another person selling it. Now, what you guys have to understand is that this person selling it or this selling point is not always or doesn't always have to be a seller, right? It doesn't have to be an actual person. Sometimes this selling point is market makers. These are market makers. So market makers at times, so when let's say Mike wants to buy 4 shares, Mike places an order to buy 4 shares at market price, at a market order. At times, you're not buying from another person. Well, a lot of the times, you're actually not buying from another person. You're buying from maybe market makers. Market makers are selling you shares. Now, the reason this is very important, right, is because market makers at times are holding a stash of a lot of shares for that stock. Now, if this transaction does happen, by the way, if let's say Mike buys 4 shares, be it from market makers, be it from Joe, be it from whoever, the volume is still 4. So what we've learned still aligns, but what I want you to understand, which is taking it to the next step and understanding everything on a deeper level, is that when you are buying or when you are even selling, it's not always to an actual person. At times, it may be market makers. So in theory, there doesn't have to be a person on the receiving end. That person on the receiving end, at times, are market makers. Market makers are the ones receiving the shares from you or selling the shares to you. And just understanding that is a very, very important step on moving forward. Now, like I mentioned before, market makers make up the market. We need them. Now, why is this whole concept very, very important? This concept is very important is because at times, market makers, like I mentioned, have a stash of shares, right? So basically, not all volume is good volume. So for example, let's say, let me break something down for you guys. Let's say that a stock is going down. As a stock is going down, the moment it starts picking up, we see a little bit of volume. Now let's just say, for argument's sake, this is a 5-minute chart. 5-minute chart meaning that this time frame represents 5 minutes. Each candle represents 5 minutes. Now, the moment the stock goes up, we see a little bit of volume. Now, what tends to happen here is immediately what we tend to think about is we're like, wow, there is buying pressure, right? There's a lot of buying pressure here, so this is a good sign. Now, if you understand volume at a deeper level, you will understand that at times this is market makers processing orders. They're getting out or in of certain shares, and that's what's causing the volume to spike, and that's what's causing the stock to go up. So for example, let's say market makers here are getting out of positions. As they're getting out of positions, what they tend to do is they tend to have a supply of shares. Now, when they have a supply of shares, they need to get out. If they want to get out, sometimes what they can do, or what they do during certain opportunities, during certain moments when they can do it, they can't always manipulate prices, and that's one thing a lot of people get wrong about market makers. They think they manipulate prices. Market makers cannot manipulate prices. They don't manipulate prices. What they do is they take advantage of certain opportunities, certain times where they can actually move the market up or down. You can call that manipulation, you can call it whatever, but at the end of the day, market makers don't really control the overall market. So I just want to put that out there because a lot of people tend to confuse that. They think market makers ultimately control the market. They make the stock go up, they make the stock go down. No, they cause fake outs, they cause certain moves that make us get trapped into certain plays. Now in this situation, market makers may have 100 shares of this stock. Since they have 100 shares of this stock and they want to sell it, what they tend to do is as soon as they want to sell it, let me just put that there, they want to sell it. They own it, and since they own it, they now want to exit. So what happens in that situation is they might start bringing the price up. They might start offering their bids and asks might cause a bigger spread. So the bid and ask might have a bigger spread. Since it has a bigger spread, whenever someone buys, it would hit the ask. As it would hit the ask, that is now causing the price to pick up a little bit. And as it's causing the price to pick up, they are now exiting because they have a huge stash of those shares. So a lot of times when you guys are looking at charts, that's why I said it's not just, it's not a walk in the park. You need to look a little bit deeper. You need to understand the whole market from different components and understand, okay, the stock is picking up, it's going up. Are market makers stepping in? Are they driving the price up right now? Are they trying to exit their position? What's going on? Is this an actual reversal? Meaning if this stock is going down, hits a certain level, and picks up, is that an actual reversal or is that a retracement? Is it having a pullback before it continues? Do I want to get trapped in here? What do I see? What do I understand? Because like I mentioned, a lot of times these market makers have these shares and they're trying to exit, or sometimes they're trying to accumulate. So if they're trying to accumulate, their whole idea of accumulation would be accumulate, buy, and then sell, right? So that's very important to understand about volume. Like I mentioned, not all volume is good volume, not all volume is bad volume. So just because you see a stock going up and volume is high, that doesn't always mean that there's aggressive buying pressure, because sometimes this is just market makers trading between one another over and over again, and there may be high activity some days there may not be. So that's what the whole move is causing. Now sometimes it's not market makers with one another, it's market makers and other people. But now sometimes if market makers are trying to exit their position, you might see a stock is going down, nice green bar, nice strong volume, and then it continues going down. right? So understanding that is very important. And like I said, as we progress through the training, I'm going to show you guys different examples of how this happens, different examples of actual trades I took, how I applied this concept, how I looked at the overall chart. But just understanding this, keeping this in the back of your head, and understanding the market as a whole is very, very important. Now, next, let's dive into something a little bit deeper. Dark pools. What are dark pools? How do dark pools work? So let's break down something called dark pool. Now, let me ask you a question, right? Let's say stock is trading at $32, right? And let's say Warren Buffett, right, the billionaire investor, Warren Buffett wants to buy, let's say, $1 billion worth of the stock. Or he wants to buy, I don't know, let's say 100,000, or let's say 10 million shares. He wants to buy 10 million shares. Right? So Warren Buffett comes in and he says, stock ABC is trading at $32. I want to buy 10 million shares. Now, if he wants to buy 10 million shares, what do you think is going to happen? Do you think he's going to go immediately to the market and tell the market, I want to buy 10 million shares? How do you think he's going to approach that? Now, the way he's going to approach it is he's not going to go to the market directly. Because if Warren Buffett or any big investor, anyone who's buying with a lot of size, I mean investing hundreds of millions of dollars or even billions, they cannot go into the open marketplace and say, hey, I want to buy 10 million shares of stock ABC. Why? Because the moment they start accumulating and the public knows, the stock price is going to start going higher and higher and higher because they're creating a lot of demand by immediately purchasing 10 million shares. So they're not going to go to the open market. What they're going to do is they're going to go to something called dark pool. They're going to go through dark pool. Now, what is dark pool? Let's understand it first and then let's break it down. Dark pools help facilitate large trading quantity by institutions who did not wish to impact the markets with their large orders. So basically, this is how dark pools work. Let's just say I am Warren Buffett. I want to buy 10 million shares at $32. I do an offer with a dark pool, and there's plenty of companies that are dark pools and they have this service. They offer to big institutions. Let's say I want to buy 10 million shares. I will then go to the dark pool, right? And I will negotiate. And I will say, you know what? I want to buy 10 million shares. They'll maybe say, you know what? I'll get you 10 million shares for $33. And that's the price I am going to guarantee you, basically. So Warren Buffett says, cool. I'm paying a little bit premium, which is fine. I'm paying $1 more. I'm maybe paying $2 more, which is fine. I understand I'm going to pay a little bit more because they're getting me 10 million shares at such a flat price, right? Because if I try to buy 10 million shares, it's not really going to work out. So now at this point, what tends to happen is dark pool's job is now to purchase 10 million shares under 33 because they promised 33 and they obviously want to make their profit. So they are delivering under 33. So what tends to happen is the stock starts staying flat. As the stock starts trading flat, this is where they're trying to keep the price flat or keep it at a certain level so the accumulation can be done. Within that accumulation, you'll see certain days of spikes in volume, right? And I'll show you examples. You'll see spikes in volume, so it'll look something like this. And I'm pretty sure you guys have seen stocks that look like this, where there's an accumulation phase, right? The stock gets accumulated, right? Then has a uptrend move. After the uptrend move, the stock then goes through a distribution move, which then they're exiting their position, they're exiting their position, they're exiting their position, and then the downtrend, the sell-off, right? So what tends to happen is big institutions or smart money is buying around here. As the stock is making newer highs or it's going on an uptrend, they're slowly taking some off the table. And as they take off some off the table, this is where retail traders start holding, investing, and then this is where smart money starts exiting again, and that aggressive sell-off causes a continuation down move. So understanding this is very, very important. Just understanding the whole concept of volume. The problem is a lot of people overcomplicate volume, the look at volume and tend to super, like after this video, I understand people are going to overcomplicate it. It's not that complicated, but when you guys are trading, you guys have to understand that it's a much bigger picture than just buying and selling. It's understanding the full marketplace. If you still don't have an idea of the full marketplace, go in the beginning video on market participants, just so you can understand market makers and who else the market participants are, because understanding that gives you a better idea on the market. And as I mentioned before, it's not as simple as looking at patterns, buying that. No, it's looking at the whole chart and understanding it at a deeper level and breaking it down from there.